Hello everyone, my name is Naomi, aka Nifty Nomi, and welcome to my channel, Be That Business. I'm a Canadian bookkeeper and a new business educator, and I help entrepreneurs look under the hood to see how it all works. I'm fighting the good fight against double work and against giving CRA more money than you have to. I've been putting out useful and interesting newsletters twice a month on the 14th and the 29th. If you prefer to read your newsletters, check out my sign-up link in the description below. There's also a link to a transcript of today's newsletter. On to today's newsletter. Hello and welcome to April 12th, 2024. If you have employees, let this be a reminder. Monday, April 15th, payroll taxes are due. Save time, pay online. Save money, pay on time. This is the third in a series on how to read your financial statements. The first was P&L versus balance sheet, link below, and last month I discussed how bookkeeping transactions affect the financials and also talked about the equity and retained earnings section of the balance sheet, link below also. Today we discuss year-end adjusting entries. Understanding what those adjusting entries are all about helps you to feel more confident in your financials and to be more familiar with what they're saying. On to this month's hacks. 3 business hacks for April, starting with number 1, amortization or depreciation. Amortization is when the balance of something decreases over time. And depreciation is when something loses its value over time. So both of these words are used when discussing the declining value of your assets. In fact, the word amortization is also used when it comes to an amortization schedule for a loan, as it shows the amount of the loan principal decreases with each payment. As I mentioned last newsletter, if you were to purchase a $3,000 laser cutter for your business, this is not an expense for the business. It is a purchase of an asset. You will see it on your balance sheet in the equipment assets balance. But assets lose value over time. How do we account for this? There are 2 categories of methods to account for the depreciation of an asset: the tax way, for tax purposes, and the GAAP way. And GAAP stands for Generally Accepted Accounting Principles. In the GAAP way, there are 5 different options to calculate depreciation, but it comes down to trying to get as close to reality as possible. For example, do you think that truck is going to last 10 years or 5 years? GAAP has these different options for calculating depreciation in order to achieve a more accurate balance sheet. But this can be very, very subjective. I mean, who really knows how long that truck is going to last? And so the government has made rules for how much a business can expense for depreciation each year for tax purposes. That's why it's called CCA, or Capital Cost Allowance. It's the amount of amortization expense that the government will allow a business to deduct from its income for tax reporting purposes. These rules can be pretty reasonable though. For example, 30% each year for a vehicle or 20% each year for general equipment, so on and so on. And so for this reason, SMBs generally just use the CRA's CCA rules for their depreciation amortization entries. But larger companies will likely have 2 different financials, one for reporting to the banks and the shareholders, and one for tax purposes, because the more business assets a business has, the more important it is for them to reflect what the actual asset values are for the business, not based on the CCA rules, but on the GAAP depreciation calculations. In fact, there is this tax incentive, it's the AIIP, link below, that allowed certain assets to be expensed instead of capitalized. Expensed is being a cost on the P&L as an expense that decreases taxable income, and capitalized means as an asset on the balance sheet as capital. So again, the balance sheet for tax purposes in this case is a lot different than the balance sheet with more realistic amortization. Many SMBs, though, they just use the CRA CCA amounts on their financials. Business hack number 2, dividends. If your business is incorporated, your business is no longer you earning money. It is its own entity. You're just a shareholder. And so if you loan the corporation money, the corporation owes it back to you. But if the corporation gives you more money than you loaned to it, things get tricky. Any shareholder loan that is negative, the shareholder pulls funds out of the corp, then a negative shareholder loan greater than 1 year is deemed income personally to the shareholder. Depending on the share structure, the shareholders now have a dividend issued on a T5 slip to bring that shareholder loan from a negative balance back to zero. Now, this is not the only time dividends are issued, but it is very common in SMBs. Dividends can be part of the shareholder compensation plan, but it's important to plan it, not just take out money willy-nilly, because you'll owe income tax personally on that dividend. Take a peek at the shareholder loan balance before your fiscal year end and discuss with your accountant if paying back some of that shareholder loan is a good idea. Because if it is negative at the fiscal year end, now the accountant creates an adjusting entry from shareholder loan to dividends issued. And that's how a T5 is now on your personal income tax return. And dividends are not an expense to the corporation, so there potentially will be income tax paid twice on that income. So planning is crucial and should be a topic discussed with your accountant every year for the year coming up. Hashtag never give CRA more money than you have to. Business hack number 3, read, review, and enter those adjusting entries. If your business is incorporated, then don't just file those adjusting entries away in a forgotten drawer. Most accountants will put a comment below each adjusting entry to briefly explain why they added it to the balances. And if something doesn't make sense to you, ask. Generally, there will be a very good reason for the adjusting entry, but learning what it is will only help you as an entrepreneur. $15,000 put to interest expense because the loan balance was wrong? Wait, so you weren't seeing that monthly interest expense on your monthly profit and loss reports? That's important to see when you analyze your profitability each month. Maybe you need to ask your accountant or bookkeeper how to put that in monthly in the upcoming year. The answer is in the amortization schedule. That's just one example of how reviewing the comments on the adjusting entries and asking about them can be a help. Also, don't forget to enter those adjustments into your bookkeeping. You'll want to know what the actual balances of the shareholder loan and other important GL accounts are when looking at your balance sheet each month. It's also a huge help to your accounting provider the next year to have those entered correctly, as it can prevent your accounting fees from being higher due to adjusting for the adjustments that weren't adjusted for in the bookkeeping in the prior year. What are your personal tips and tricks for creating efficient processes? I'd love to share them in an upcoming newsletter and give a shout out to your business. If you found this video useful, don't forget to subscribe to my channel. I'm also on Instagram at BeThatBusiness, and you can tweet at me, X at me. I'm at NiftyNomi, and I'm also at NiftyNomi on Twitch and TikTok. And you can find resources and courses about running a Canadian business on my website, naomiwilkins.ca. The video today was recorded in beautiful Gananoque, Ontario. Thanks for watching, and get out there and be that business that thrives.